Hello, everyone. I'm Barry Corcoran.
I'm Lawson Corcoran, and today is another episode of Financially Speaking. Well, Barry, there's been a lot going on in the news the past few months, especially a lot since the tariff liberation day about 2.5 months ago. I think investors and clients of ours and citizens just in general just have had a lot of concern and anxiety, and I think people are kind of getting used to the news cycle. There's just a lot that's going on, a lot of chaos. There's a lot going on Twitter, on different blogs. Everyone has an opinion. There's all sorts of information. Some of it's true, some of it's not, and I think a lot of people are exhausted. So I think today is a great day to sit down and kind of hash out some of these events, specifically the tariff situation, see how that may or may not have affected, investment portfolios, and just talk about moving forward, kind of best practices and leaving the emotion out of investing, kind of limiting these bad decisions or mistakes that one can make um, you know, when things get emotional, when things get complicated. So yeah, you want to start there? Start with the tariffs. 2.5 months again. Early April, the Liberation Day, markets dropped. Where are we now? Is that still part of the conversation?
It certainly is, but at first I have to say that it's been a remarkable 6 months for investors. In the middle of February, we saw new stock market highs. After the April announcement of tariffs, the market dropped sharply. And then we're going to tell you what's happened to the market since then. And then we've had a huge geopolitical event that's developed in the Middle East. So indeed, there is a lot that's going on. But I think this 6 months is a really perfect example of what behavioral economics tells us
Mhm.
about what our emotions drive decisions that maybe aren't so good, and that our investment decisions should be based on information and data rather than emotions. Sometimes I wish I could go back to the feelings that we had surrounding April the 2nd. And there was so much emotion that we were picking up from the national news and, as you said, Lawson, different sources of information. And it was a chaotic time, triggered lots and lots of emotions. In the midst of that, we told some of you there's going to be a point where we think you'll wish you had gone to the bank to borrow money to buy stocks on April the 3rd. And indeed, there is a market recovery. So, where do we stand now? Well, it appears that the effect of tariffs on the economy and corporate profits have been fairly muted. What we don't know yet is how much cash that's brought into the US Treasury, which would be a positive for the federal deficit. And what we do see are companies saying that they're not going to raise prices on their vehicles, or they're doing things to mute the effect of tariffs on you, the consumer, at the point where you're buying, whether it's vegetables or an automobile or a refrigerator. And as we said at the time, corporations figure it out. And I think that as they get acclimated to the effect and the impact of these tariffs, they are beginning to figure it out. What Wall Street is telling us right now is that second quarter corporate profits are going to be healthy, and that the effect of these tariffs are not even close to the worst case scenario that was being broadcast in the media and other voices at the beginning of April.
Yeah, I think 2 points behind that. One, a lot of the tariffs that were announced on Liberation Day, so called, were negotiated down, and kind of there was broad sweeping tariffs on multiple countries and industries, and now it's kind of been dissected into different sectors of the U.S. economy and different trading partners. So I think it's a lot more manageable for these corporations to adapt. I do agree with you that so far, what a lot of the indicators are saying is that corporate profits are going to be stronger than a lot of people thought. I think a lot of people thought on April 2nd that this is the end and we're going straight into a recession, and we're just kind of expecting the worst. And I do think that it will take a few quarters for it to completely play out. But yeah, it really has shown the resiliency of both the American consumer and just American companies in general to adapt. I think a lot of that has to do with AI and just how much productivity that there is nowadays coming down the pipeline. So, yeah, to your point, let's take a look at a chart here. I'm going to share this with everyone.
Yeah, while you're bringing up that chart, one thing that we don't show in the chart is inflation. And of course, what many commentators were saying at the beginning of April was that there was going to be huge inflation, and we're going to go into a period where the Fed had to raise rates to stem inflation. And although we don't show it on this chart, inflation has really been muted, and some elements of inflation have actually declined over the last 2 or 3 months. So that was another positive indicator
Yeah.
that we've seen over the last few months.
Yeah.
I love the I love the chart. It shows the stock market, the Bloomberg aggregate bond market, foreign stocks that MSCI EAFE is an index for foreign stocks, and then the gold shares tells us what happened to gold. So this chart begins looking at January 1, 2025 data, and you can see in February where the blue line hit that all-time high, and then it began to slide off as talks of tariffs, and then the announcement that actually occurred in August. April, the first week of April, and then as normal, the market had a sharp rebound in the middle of April, kind of sideways for a while. As it approached May, we begin to see the recovery. And so in this example, by the end of May or the beginning of May, we see that the market actually recovered its losses in only 1 month. And then it continues, the blue line, all the way through May. May was a very positive month for stocks, and it's recovering and almost has recovered back to its all-time high. It seems to be moving towards that. So it's astonishing to us that the stock market through all of this is up about 3% since the beginning of the year. The green line shows us the behavior of bonds. And bonds in your portfolio is a stabilizer, and they've really played their part. Their return is similar to the stock market, but doesn't have the volatility that we saw in stocks. The foreign stock market has had a remarkable return since the beginning of the year of 16%. And of course, foreign stocks dropped dramatically, but you can see since the beginning of the year, by that purple line, foreign stocks was vastly outperforming the U.S. market and rebounded strongly and has had a return that's remarkably higher than the S&P 500, and of course higher than bonds. And the last that's exciting to us is that gold played its exact role in portfolio design, is that it's moving in the opposite direction of the stock market. And so that's why you see at least these four elements in your portfolio. It's effective diversification where some parts of it is going up and some parts of it is actually going down. So great example of how the market has a drawdown for whatever the reason, and that it recovers and then continues to grow.
Yeah, two more things I want to point out. One, if you were to not pay attention at all to these indices and you weren't tracking stocks or different asset classes and their prices, kind of like we are, and if you just paid attention to the news and you logged on Twitter and Facebook or whatever you go to, different blogs, Wall Street Journal, there's, every different news outlet you could possibly think of to get information out. But if you just paid attention to that for the last 6 months, I think you would probably expect markets to be down drastically. I think there's a lot of emotion out there, and a lot of these news sites, they are paid based on, um, how many interactions they get. They want people interacting with their media and their content. And the way to do that easily is just create emotion. Um, and that's not good as an investor, right? Because for example, this tariff liberation day, where you know gold even dipped, foreign stocks and domestic stocks, everything was down for a few days, and it was down big. Um, and everyone was watching the news, everyone was reading. There were so many people that instantly turned into these university scholars on tariffs. People that had never even talked about tariffs their entire lives, just were coming out, had all these opinions on what was happening, and they thought they had it figured out. And what we saw is that that didn't matter. And those people that ended up selling during the midst of that volatility, that downturn, man, if you sold stocks then and you hopped into bonds, I mean, just follow that green line right there. You're never going to get back to where you were, right? Like if I sold here, if I sold it at this low and I hop into bonds and I stay there for the next few months, I'm not going to get, this updraft that we get afterwards, this recovery. That's where, that's where we want to help clients. We talk to so many people, and at the end of the day, you can only do so much. If someone wants to sell, they want to sell. But just hope this is a really good learning lesson in the idea of managing your emotions. We speak on it so much, but we have to separate our feelings about politics, an administration, certain actions taken, the news. We have to separate our emotions around that from our investment portfolios, because if we don't, then it's going to cost us at the end of the day. You're not going to, if you sell here, you're not going to be able to ride out these massive gains in this recovery. You're not going to be able to take part in that. And that really is important, because it's not just about making more money, but, you know, some of these goals that we discussed with clients, why do we need your investment portfolio to grow? Well, that directly affects retirement. That affects sending kids to college. That affects, taking care of your parents as they age. These are things that it's life. It's not like we're just trying to make more money for the sake of making more money, but limiting these decisions directly affect your capacity to do those things within the next 5, 10, 15 years. So I just kind of wanted to point that out, that hopefully this is a great learning lesson that we can all take from the last few months. There's been so much volatility, but those that have stayed diversified through these asset classes, stayed involved, stayed in the market, are the ones that come out on top. And, Barry, I'm sure you've seen that more times than you can count in your, 40 some odd years of doing business.
Yeah, I mean, the pattern is so amazingly similar. And for me, having witnessed and gone through it so many times, um, my reaction is different than most people's reaction, because we know the data, we know the history of these drawdowns, and we don't know when it's going to recover, how long it'll take to recover. But this pattern is so amazingly similar. The other comment about the media is that when you see the financial activity in the first couple of weeks of April, it's all over the press. It's on the front page of the newspaper. It's in the media. It's in the news. It's everywhere, and that just instills emotions and fear and frustration. But you probably really haven't heard very much about May, which was a great month in the stock market, and June, which is a good month in the stock market, and so that's not newsworthy. So, we just have to, we just have to tell people, just don't watch those talking heads.
Yeah,
Enjoy
yeah,
life, enjoy life, and move on.
Yeah, a lot of the news that sells is bad news, and it's
Yeah,
surrounded by chaos. And let me just share that chart one more time. Going back to selling and hopping back in the market, one of the many conversations we had with those that wanted to sell during this downturn was, when are you going to decide to hop back in the market? Because a lot of people said, hey, I'm just not comfortable with stocks now, and I want to wait till things look better. And it's like, okay, well, when is that for you? Like, what's the benchmark that means that you're ready? Are you tracking economic indicators? Are you tracking certain indices? um, because I think a lot of times people just think, well, I'm just going to wait till it seems better, and sometimes that's quarters or years. And
yeah,
people look up and they've missed out on double digit gains for 3 consecutive years. And that's really an issue, because again, that's what affects retirement. That affects your capacity to send your kids to college, and that's what we want to help you manage through. I think something we just talked about before we hopped on this call was, um, we want clients to trust our research and the information that we track. um, you know they pay us to do this so that they don't have to sit at home, waking up in a cold sweat thinking about, oh, I need to go read up on this or that, tariffs or tax policy or or what have you.
yeah,
We want them to have peace about it, because we have all this information. We watch this stuff daily. We're involved heavily in the information side of things, and so we want people to feel comfortable that they don't have to spend every waking moment of their life, and they don't have to waste emotion or energy tracking these things, because that's what they pay us for.
yeah.
So I think that's a really important point. Any last thoughts on just kind of those major asset class returns year to date? Just kind of before we move on to one last thing.
Diversification works, and
Yeah,
this year we've seen that it works very effectively.
yeah. So last thing, geo geopolitics. There's just been a lot of a lot of events happening recently, wars and rumors of wars, and just all this conflict. And I think going back to the fear and the emotion, it's all in the news, and it just affects people's day to day. It just makes people sad, makes people anxious. Um, so, can we talk about what geopolitics means for our investment portfolios? Because again, that's kind of what the goal is. We're not trying to solve the problems of the world. We kind of leave that to voters and politicians, and we're looking at the math. What affects
Yeah,
our investment portfolios? Let's control what we can control. So, tariffs kind of falls under that category, but again, also these wars. The U.S.'s involvement. With Israel against Iran this past week. Um, we look at the Ukraine Russia war. It's still dragging on. Things are still unresolved in Gaza. There's just so much going on. There's still terrorism all over the world. What does that kind of mean for our investment portfolios? Is that something we need to even be paying attention to, like we've talked about, the past few minutes?
well, geopolitical events are events that occur across the globe or different countries, and it can be a war, it can be a regime change. It's an unexpected event that affects the global economy, or affects the whole complex global economy and trade. And so, those can include assassinations of presidents. They can be wars, and we don't control geopolitical events. They just happen. Um, and I guess if you're in Europe and you saw the last election, the outcome of the U.S. election was a geopolitical event, because it seems to be affecting the world. And so we see all kinds of examples. They're unexpected, but they happen from time to time. So do geopolitical events cause us to take a different look at your portfolio and make changes? Absolutely not. Because when we look at the history of geopolitical events, we see something that's probably surprising to most investors. Lawson, if you want to
Yeah,
pull that
yeah,
chart up.
another great chart here. Uh, as we can see, this indexes several different events throughout the last 20 years, everything from 9/11 to the Iran drone strike back in 2019. When Russia invaded Ukraine, there's a lot that's gone on, and what you can kind of see is there's really no clear correlation between these wars and major geopolitical events and the stock market, because this what this looks like is the S&P 500, 3 months, 6 months, 1 year after each of these events. Um, and over half of them the stock market ends up positive, but again, there's really no clear correlation that says, hey, every time something bad happens that's very notable relative to other current events, do we need to sell? And that's just not the case.
Yeah.
It's really important to stay diversified, just as we showed in that other chart. It's not about trying to time everything, every piece of bad news that comes out. We don't need to evaluate, where we're putting our money, because if we did that, then we'd be moving money every single day. There's always something new.
So another good point about this chart is look at the time, the column of 3 months, 6 months, and 1 year. And if you go to the 1 year, you can see that in these examples, there's only 2 years where the stock market was negative. We have to go back and look at to see how the U.S. economy was. The condition of the U.S. economy 1 year later after these events. Was there something about the U.S. economy, or was it that geopolitical events? But we can clearly see the difference between the first 3 months and then 6 months and then 1 year later. So it's you can't time these markets, and so the idea of trying to get out sometime soon after a geopolitical event and get back in, it's very difficult, impossible to time that. But the bottom line here is that after 1 year, it these geopolitical events really don't matter much to the accumulation of your wealth. Even if you're retired and you're 69 years old or 70 years old in the beginning years of your retirement, 1 year later, you're still going to be okay. So it's a very interesting chart about geopolitical events. I don't know about what the media, whether they kind of handle the fear, the fear factor in geopolitical events the same way they do with tariffs. I sense that there was a difference, between the two. It seemed like this thing with Israel and Iran was over 2 or 3 weeks was pretty short and pretty dramatic, and so this seems to be that there was kind of a difference in what we see in the media.
Yeah, and just one last thing. We've said it a million times, and we'll continue to say it, but it's just about staying diversified. If the math was different, then we would say something different. But clearly,
Yeah.
time and time again, it just proves that staying diversified, not just in oh, I'm going to have stocks and bonds and cash. It's no, there's several different sectors and asset classes within stocks that we want to stay diversified in, because they react differently throughout different cycles. Same with bonds, same with gold and commodities. There's multiple ways that we diversify. Our methodology is firm, and it doesn't change. There's a reason that we construct portfolios the way that we do, and it really comes down to the math of it. And so I think it's really important to remind people of that. That sometimes it may sound like, oh man, uh, maybe it sounds like I should never sell, and that's not necessarily the case. there's times where it calls for, your portfolio calls for rebalancing and shifting towards one asset class or the other. But a lot of the times, if you're going to do that based on emotion and the market, because of volatility or geopolitical events or political events in the U.S., whatever it may be, if you're doing that based off emotion, you're going to fail more often than not, because you're trying to pick winners that everyone else is trying to pick, and that's just impossible. So doing it based off math and based off research, and not doing it frequently, but letting those winning asset classes kind of ride out and experience some of those gains is really important.
So in summary, wrapping up, what do we expect for the last 6 months? Of course, we never know, but we actually feel good, feel positive about the direction of the economy. We'll know whether there was the GDP or the growth of the economy for the second quarter. We'll know that soon. Corporate profits will begin to be announced in July. Inflation seems to be subdued and getting closer to the 2% target that's pursued by the Federal Reserve. And so we actually feel pretty good. We see some commentaries that are expecting the stock market to pierce all-time highs and have very positive returns for the year. And our point of view is that we're, although I think I'm just continually optimistic. I am optimistic about how we see things going forward in the second half of the year. So
Yeah,
uh,
I think with AI, AI is really,
yeah,
really just continuing to grow businesses and just exceed expectations for all different, asset classes. Um, Things all over the economy are just really benefiting from AI. So I think that's really bolstered a lot of the growth, and will continue to do so. And I also think, just reminded that the American consumer is very, very, very strong. I think it's no surprise that we see that, but it's just a reminder that American capitalism proves time and time again to bolster new highs that exceed expectations, when there's been a lot of people that have been bearish in the last few years and called for recession, and the American consumer has just kind of gone against that, just very resilient. So yeah, I think it's an optimistic second half of the year.
we hope that you all will contact us if you have any questions or need help. We hope that you'll stay cool for the next few months
Yeah.
because it looks like it's going to be a hot one. We appreciate the opportunity to serve you and your families, and we're honored by that. I'm Barry Corcoran with Lawson Corcoran. This is Financially Speaking. It's June 24th, 2025. Have a great day.